Someone recently reached out and said, I'd like to put $100,000 into a whole life insurance policy, and here's what I'm interested in. To start, she's 60 years old and she's in relatively good health. She said that she's not interested in a legacy or in a death benefit at all. Her main goal is cash value. So when looking at the death benefit, the main goal here is to set it at the lowest amount possible while preventing what is called a modified endowment contract or a MEC from occurring. So with a life insurance policy, it's very common to see people interested in the cash value benefit, because if you do everything right, meaning you don't allow your policy to become a modified endowment contract, you can access the cash value tax-free, which is nice. Now, any life insurance policy can become classified as a modified endowment contract if we put in more money than our MEC limit. That limit is just the maximum dollar amount you could pay into the policy per year. That limit is determined by your age and total amount of life insurance. So what we'll do with the policy is set the death benefit at the minimum amount possible to prevent the MEC from occurring, which still allows her to access the cash value tax-free. I know that's a lot of information. Next, she said that she prefers a major mutual company. There are 4 of them. They are considered the 4 major mutual companies, who are Mass Mutual, Guardian, New York Life, and Northwestern Mutual. She mentioned that the total dollar amount she would like to dedicate to this whole life insurance policy is $100,000. She might be interested in doing this in a lump sum. She's not sure yet though. If she does fund the policy with a lump sum, she'd be interested in looking at what is called a premium deposit account, which is, think of it as a holdings account that you can park money with the insurance company. They credit interest to that money while over the years it feeds your whole life insurance policy. I will go through an example of exactly what that looks like. Now, if she doesn't use that premium deposit account, call it the holding account, then she'd like to be able to spread that $100,000 out over a 3 to 7 year period. And really, she just wants to put the money in the most efficient manner. Meaning, if I said to you, insurance company, I've got $100,000. If I put it into my whole life insurance policy all up front, or if I spread it out over 4 years, which option is going to yield me the most cash value? The answer for her at age 60 is going to be over a 4-year period, just about 4 years. 3 and 5 years will look similar, but 4 years is going to be the sweet spot in this particular case. Now, she also asked about the guaranteed values. I'd like to see them and exactly what that looks like. I'll show you the guaranteed values as we go through everything. Now, flexibility is very important if she elects not to proceed with the premium deposit account. Meaning if she said, hey, I want to fund that $100K over 4 years, that's $25,000 per year, but I don't want to be obligated to pay the full $25,000 all up front on the beginning of each policy year. Meaning, can I set it up where I'm committed just to a minimum amount, and then at my discretion, not paying monthly or anything like that, but when I want to, can I just log on to my online account or use my mobile app and throw extra money into the policy? That is possible. If we look at your 4 major mutual companies, Guardian allows that type of flexibility. She's very interested in upfront cash value, and she'd like to see a break-even point somewhere between 4 and 6 years. The break-even point represents the first year that your cash value is equal to or greater than the total dollar amount you've paid into a policy. Now, with money going into the policy, she would like the minimum base premium. She'd like a term rider attached to prevent that modified endowment contract. And then she'd like to add everything else to her paid up additions rider or PUA rider. I also like to refer to this as a cash dump in. You'll find that adding as much money as an insurance company will allow you to add to your PUA rider will maximize the upfront cash value, and in the majority of cases, it'll also maximize the long-term cash value, which is very cool. Now, when she's done funding the policy, she would like to see her dividends used to support that base premium. Meaning after she puts $100,000 into the policy, she wants assurance that she is never going to have to pay more money into the policy, which we can easily assure based on the current dividend rate. She would also like to see the guaranteed values though, which we will look at. A great way to stress test a policy to know that you won't have to pay more money in after you get your target amount in, $100K in her example, is to see if that's the case when you look at the guaranteed values, which is nice. Now, she'd like the ability to borrow the cash value tax-free. She mentioned, I'd like the ability to do this after 5 years. The good news is she could do it after 10 business days if she wants. Whatever she has in cash value, she'll have access to as early as 10 business days after starting a policy. She mentioned that she would like what is called a terminal illness rider attached to a policy. With a whole life insurance policy or any type of life insurance policy, guess what? Terminal illness is always attached, meaning if you are diagnosed with a terminal illness, the insurance company will advance you up to 80% of your death benefit to be used for whatever you want. It's usually used for healthcare costs and other related things, but you'll see most life insurance policies do offer that, which is nice. Now, she also asked for either long-term care or living benefits. With a life insurance policy, you could attach what is called a pure long-term care insurance rider. This often comes at an added cost. If the company offers it, you can also attach what is called a living benefits rider. We mentioned Guardian might be a good fit earlier for her based on the PUA flexibility where she can add money at leisure. Guardian also offers a free living benefits rider. It is referred to as an EABR, Enhanced Accelerated Benefit Rider, which how it works is if you're diagnosed with a chronic illness, meaning you have to go into a nursing home, you need home health care, the specific contract language states if you're unable to perform 2 of the 6 acts of daily living, like being able to bathe yourself, feed yourself, dress yourself, that kind of stuff, then that rider kicks in. And similar to the terminal illness rider, you can access a percentage of the death benefit to help satisfy those costs. It's not automatically 80%. Eventually it does get to 80%, but if I'm younger, you'll find that you won't have access to 80% of the death benefit to help cover those chronic illness costs. She's interested in a lot. Let's take a look at what we showed her. So we showed her Guardian because that is what she was primarily interested in, being that they are one of the major mutual companies. They have a flexible PUA rider. They offer a premium deposit account. Usually I like to show multiple options, but for her, that worked out well. So the products that we looked at in this case is their L95 policy, 2 different versions of that. One is their 5% PUA fee. The other is their 10% PUA fee. The difference between these two, the 5% PUA fee will have more cash value up front, an earlier break-even point, and higher guaranteed cash values. Remember, a break-even point somewhere between years 4 and 6 and strong early cash values was very important to her. So this option is going to accommodate that. However, when we look at the 10% PUA fee, you will see greater long-term potential. So some people like that. What I like to do is show both side by side. This way people can see it. Then we also decided to show their 10-pay policy. And the reason why is because long-term cash value looks good. Now, starting at age 60, long-term is a long time where sometimes people look at it and express to me, I'm in my 80s. Like, I don't know that I'll necessarily make it that long. Like, I don't really care. I'd rather have more in the next 10 or 15 years. I'm like, totally get it. But we did want to show this. Now, the thing about the 10 pay is it does require a higher base premium, which is something she expressed she did not want. And also, the guaranteed values are not as attractive. So the guaranteed rate with the 10 pay product is 2%, whereas the L95 product, both versions, is 3%. So there is a trade-off there as well, especially when we look at the guarantees. So let me just put it up here. That's why we've got it this way. Nice. But those are the different options we looked at. And what we looked at is option A, funding the 100K lump sum each year, transferring money from your bank account to the policy. So starting at age 60, in decent health, so we looked at a regular preferred rating. What we'll look at here is dividing it over 4 years, as that will look attractive, comes out to $25,000 per year. And what you'll find here is that the minimum premium is going to be about 10% of that, which includes the base premium plus the cost of the term rider. So option A means she leaves her 100 grand in the bank. The policy is set up where she can fund a maximum of $25,000 per year. 25K is going to be her MEC limit. So we'll have the minimum death benefit set up in order to accommodate that 25K MEC limit. You'll see exactly what it is in a moment. And then the minimum premium will be $2,500, which means she can literally set it up where she's billed for about $2,500 per year. And then when it comes to her PUA rider, she can add up to another $22,500 per year. But she's not required to do so. So now it's very, very flexible, which was something that was very important to her. So that's option A. Option B is the exact same product, or product options, I should say, but using the premium deposit account, or holding account, I like to call it. So what this involves is taking money from her bank account, giving it all to Guardian. So she puts the full 100 grand here. This earns interest, which the rates have actually been updated since the illustrations that I'm about to show you were put together. It's at about 5.5% right now. Depends on the term, but it can be between 5 and 5.5%. But it earns interest. And then what happens in a case like this, over 4 years, that 100 grand is transferred from the deposit account to her whole life insurance policy. And because it's earning interest, more than 25K per year goes in per year. It's more than $26,000 per year. So now she actually gets more money than $100,000 into her policy. Now, the interest that is being produced from the premium deposit account is taxable as ordinary income to her each year as it is dispersed into the policy. So if you put in 100 grand and then 26K per year for 4 years was moved into your policy, the $1,000 of interest there, that is what's going to be taxed as income each year. And insurance companies will show you exactly how the taxation works. You can just check off a report, punch in your tax bracket. It's pretty cool how it works. But what we're going to look at are these two options. And what we'll look at are things based on the current dividend rate and then also the guarantees. So let's take a look at the illustrations. We've got the PDF illustrations. Here's one example of the 25K per year for 4 years based on the guarantees. This is the 10% PUA fee. Then here's the non-guaranteed values based on the current dividend. Then we also have the premium deposit account. How we can tell is we see 26, almost 27,000 per year going into the policy. This example assumes she gives the full 100 grand to Guardian. They deposit it into their premium deposit account, and then that feeds her life insurance policy over the next 4 years. For the sake of time, let's look at the numbers on Excel. We'll start with the 5% PUA fee product. 25K goes in, her cash value, $20,000 and change. She wanted a break-even point between 4 to 6 years. Her break-even point is between 4 to 5 years in this particular example. Not bad. This is based on a regular preferred rating, which is what she wanted to see, which is what she feels she can get. There's a step above. There's also one step lower that she could get. Time will tell. But regular preferred rating, there's the L95 5%. Here's the L95 10%. And again, this is option A, assuming she just moves the 100K into the policy over 4 years and then stops. Okay. What do you notice? For the first 4 years, right, let's actually go first 4 to 5. 5% is cash positive by the 5th year. 10% is cash positive by the 6th year. Takes a little bit longer. Which one has more money by year 10? Pretty much the same. The 5% has more for the first 10 years. From the 11th year onward, you'll see more with the 10% based on the non-guaranteed values. So that is something we want to show. Based on her concern for early cash value, I do think that 5% is something that she's going to lean toward, but it is up to her. And then you've also got the 10 pay. 10 pay, weakest upfront, takes the longest to break even, does give her the lowest death benefit upfront, which she said she didn't care about that, which is nice. Well, nice that it's lower, so it accommodates one of her requests. But as we look at it over the long haul, by year 20 is when it really starts to cook. And by then she's pushing 80 years old. Like if we go down to year 30, now I see the most, 325 compared to the L95 10%, you're at 316 now. Yeah, not that much of a difference really when you look at it. The 5% is lagging more on the far left. That's year 30, 89 years old. So her emphasis was really upfront cash value. That's what she was interested in. But that's option A. Let's look at option B. Here's the premium deposit account. So what we see here, the L95 5%, 100K deposit, that then feeds $26,858 for the next 4 years. Her total out of pocket is still $100,000. That's what she paid, even though more than $100,000 got into the policy. So what that does is by the 4th year, after all of the money has gone in, she's got 105 and change, which is so weak. With the 10% PUA fee, by the 4th year, she's got 102, almost 103. If we look at it by the 10th year here, look at this. Pretty cool, huh? That 10% starting to look stronger, which is nice. And then you also have the 10-pay product, which long-term does look better than the 2 examples to the left. But long-term is when she is in her 80s, which again, sometimes people don't really care about that. So those are the different examples based on the dividends. If we look at the guarantees, what this does is give her the assurance that she does not need to pay after the 4th year. That was the big reason for looking at the guarantees and seeing that the cash values look decent, which you're looking at a worst case scenario. But here, they still look decent, which is nice. So there are all 3 products side by side, the deposit account, back to the manual example. And we can see those on the illustration as well, underneath the guaranteed values section. But those are the different options we showed. She had a large list of requests based on what she had requested and what she's looking for, low minimum premium, strong guarantees, different product options. I do like Guardian for her. That is what we proposed. In the event she wants to see additional options, there are other companies that we could look at. She might give up a few of her requests, but you could still accommodate what she's looking for quite nicely. Hope you enjoyed this one. I'd be curious to know which one you would pick of the 3 different products. Let me know in the comments below. And as always, I hope this helps.